If you've recently started driving for a rideshare app, consulting, or just picked up a side hustle, this is your essential freelance tax guide. We'll discuss how to handle quarterly deadlines so you don't face a crisis in April, and I'll give you the specific percentage you need to move into a separate savings account today to keep your budget safe. It's time to turn that tax anxiety into a confident plan. Let's get started. If you're coming from a traditional 9-to-5 job, you're used to a certain rhythm. You agree to a salary, you get your paycheck, and the number is, well, it's always smaller than you calculated in your head. That's because your employer's payroll department has already skimmed off the federal taxes, state taxes, and FICA before the money ever touches your hands. But when you start freelancing, consulting, or driving for a delivery app, that safety net disappears. You get the whole check. This creates what I call the bonus money illusion. Let's say you made $500 driving for a rideshare app this weekend. That $500 hits your account, and it feels like pure profit. It feels like bonus money. You might go out to a nice dinner or pay down a credit card bill with it. But here's the hard truth. That money isn't all yours. The IRS still has a claim on it, and because nothing was withheld up front, you are walking into a potential case of tax shock when April rolls around. So why is the bill often higher than people expect? It comes down to your new identity. In the eyes of the IRS, you are no longer just a worker, you are a sole proprietor. And this brings us to the dual role of the 1099 worker. Think about Social Security and Medicare, what we call FICA taxes. When you have a W-2 job, you pay half of that cost and your boss pays the other half. It's a split tab. But when you are self-employed, you are wearing two hats. You are the employee doing the work, and you are the employer running the business. Because you are the boss, you have to pay the employer's half and the employee's half. That totals 15.3% of your net earnings. That specific 15.3% is what we define as self-employment tax. It is separate from and in addition to your regular income tax. I know, that sounds heavy. And you might be thinking, Alex, I just do this on the weekends. I barely made any money. Surely the IRS doesn't care about my side hustle. Here's the kicker. The payment threshold is shockingly low. Many people assume you have to make thousands of dollars before this kicks in. In reality, if your net earnings, that's your profit after expenses, are just $400 or more, you generally must file Schedule SE and pay self-employment tax. And for my listeners working within a church setting, that threshold is even lower, just $108.28. $400. That's it. That could be one good weekend of deliveries or 2 graphic design logos. If you cross that line, you aren't just a person with a hobby. You are a taxable business entity in the eyes of the government. So, to make sure we are all speaking the same language for the rest of this series, let's lock in these terms. When I say 1099 taxes, I'm talking about the unique burden of being your own boss. And when I say self-employment tax, I'm specifically talking about that 15.3% contribution to your own Social Security and Medicare. I want you to take a second and reflect on your mindset. When you see that money come in from Venmo, PayPal, or your gig app, do you see it as gross revenue for a business or just extra spending cash? Shifting that mindset is the only way to avoid that surprise bill. So here's your homework for today, and it's easy. I want you to open your bank statements or your earnings app right now. Look at how much you have made year to date. Subtract any direct expenses you've had. If that net profit number is over $400, stop treating it like a hobby. Acknowledge that you are a taxable business entity. It's easy to look at that self-employment tax number and feel like you're just being penalized for being your own boss. But before you spiral into buyer's remorse over your side hustle, I want to change the lens. We need to reframe this. When you pay that tax, you aren't just throwing money into a black hole. You need to view that payment as a premium. You are buying into a mandatory government-backed insurance package. That 15.3% isn't a fee. It's an investment in the future you. It is directly funding your Social Security retirement credits, your disability insurance in case you get hurt and can't work, survivor benefits for your family, and your future Medicare coverage. If you were working a traditional 9-to-5, you wouldn't think twice about these benefits accumulating in the background. As a 1099 worker, You have to actively buy them. Now, I know what you're thinking. Alex, that's great for the future, but my bank account hurts right now. Well, here is the silver lining, and this is something a lot of 1099 taxes guides gloss over. The tax code recognizes that it's unfair for you to pay both the employer and employee share. So they attempt to level the playing field. When you file your taxes, you are allowed to take a self-employment tax deduction. Essentially, you can deduct the employer equivalent portion, that's half of your SE tax, from your adjusted gross income. This lowers the total amount of income tax you owe. It doesn't erase the SE tax, but it definitely takes the sting out of your final bill. But here is the kicker, and if you take nothing else away from this episode, please listen to this part. There is a use it or lose it rule when it comes to your Social Security credits. I talk to so many people in the gig economy who think, I didn't make that much on DoorDash this year. Maybe I just won't report it to save the hassle. That is a dangerous game. The Social Security Administration has a strict statute of limitations. You have exactly 3 years, 3 months, and 15 days from the end of the tax year to report that income. If you file late, past that window, you could lose those credits forever. Even if you pay the tax later, the SSA might say, sorry, too late to count this toward your retirement. Imagine working hard for 5 years, failing to file your Schedule SC on time, and then finding out when you're 67 that those working years count as zeros on your record. That could cost you hundreds of dollars a month in retirement income. So, accurate reporting isn't just about keeping the IRS off your back today. It's about ensuring that the safety net you are building is actually there when you need it. To wrap this up, stop looking at self-employment tax as a punishment. It is your mandatory savings plan. The deduction helps balance the scales today, but your compliance ensures your security tomorrow. I want you to take a moment right now, whether you're on the treadmill or in the car, and reflect on your current retirement planning. Ask yourself, is my tax compliance creating a foundational safety net for my future, or am I risking my long-term security to save a few bucks today? But let's be real for a second. Knowing why you pay is one thing. Actually having the cash in the bank when the IRS comes knocking is a completely different animal. That brings us to our action plan. We're going to talk about logistics, deadlines, and the specific savings strategy you need to survive your first year as a freelancer or gig worker. If you are coming from a traditional 9-to-5 job, you are conditioned to think about taxes as an annual event. You file in April, maybe you get a refund, maybe you owe a little, and you move on. But for 1099 taxes, that annual mindset is actually a trap. Here is the reality. The U.S. tax system is pay as you go. When you were an employee, your boss withheld money from every single paycheck. Now that you're the boss, you have to do that. If you wait until April 15th to pay everything you owe for the previous year, not only will you be hit with a massive bill that you might not have the cash for, but you might also get hit with underpayment penalties. Generally, if you expect to owe $1,000 or more when you file your return, the IRS requires you to make what are called estimated tax payments. This means shifting your brain from annual mode to quarterly mode. You aren't just filing once a year, you are making payments 4 times a year. Now I can hear the panic setting in. Alex, how do I know how much to pay? I drive for Uber. My income changes every week. Don't panic. We are going to operationalize this with a very simple rule of thumb. Think of the IRS as a silent business partner. Before you pay your rent, before you buy groceries, and definitely before you buy that new gear for your business, you need to pay your partner. The magic number is 15.3%. Here is your strategy. Every time you get paid, whether it's a payout from DoorDash or a check from a consulting client, take 15.3% of that net profit and move it immediately. And I mean physically move it. Do not leave it in your checking account. If it sits in your checking account, you will mentally label it as spending money. You'll buy a coffee, you'll pay a bill, and suddenly that tax money is gone. When the quarterly deadline hits, you'll be scrambling. So how do you actually get this money to the government? We need to talk about 2 specific forms that are going to be your new best friends. First, for those quarterly payments, you're going to use Form 1040-ES. It sounds technical, but it's really just a payment voucher. You can even do it online directly through the IRS payment portal. It's how you ship off that cash you've been saving so you aren't holding a massive liability at the end of the year. Then, at the end of the year, when you file your main tax return, you'll use Schedule SE. This is the form where you calculate the final self-employment tax owed. This is also where you claim that silver lining deduction we mentioned earlier, deducting the employer half of the tax to lower your overall income tax. So, let's look at the compliance checklist to wrap this up. 1. Check your earnings. Did you profit $400 or more? If yes, you're in the game. 2. File on time. Remember the use it or lose it rule? You need to file within that 3-year window to get your Social Security credits. 3. Use the tools. Use Schedule SE to calculate it and Form 1040-ES to pay it quarterly. By treating this like a system rather than a surprise, you stop fearing the mailbox. You move from being an accidental entrepreneur who is scared of the IRS to a business owner who is in control of their financial destiny. So, here's your challenge for today, and I want you to actually do this as soon as this episode ends. Open a dedicated savings account. Call it Tax Vault, call it IRS Fund, call it whatever you want. Look at your profits for the year so far, calculate 15.3% of that number, and transfer that cash into that new account today. Future you, the one who isn't having a panic attack next April, will thank you. And that brings us to the end of today's essential freelance tax guide. We've moved past the initial shock of the bonus money illusion and equipped you to truly seize financial control of your business income. Today, we face the hard truth about self-employment tax, that being your own boss means covering both the employer and employee portions of Social Security and Medicare. We learned that the threshold to file Schedule SE is surprisingly low at just $400, and that failing to file on time can actually cost you your future retirement credits under the use it or lose it rule. But most importantly, we turned anxiety into action. By treating your 1099 taxes as a pay-as-you-go system and setting aside that critical 15.3% of your net profit right now, you are protecting your future self from a budget crisis next April. Thank you so much for trusting me with your time today. If you found value in this roadmap, please check the show notes for a link to the summary checklist we discussed and consider leaving a review. It helps other accidental entrepreneurs find us. Make sure you're subscribed so that you will be notified when more tax episodes drop.